Hey friends, I wanted to record a quick video for you to talk about why your monthly payment is what it is. One of the number one objections or claims that we hear from our clients to why they want to wait to move is they're waiting for interest rates to come down or to drop to result hopefully in a lower monthly payment. However, what we have here is a diagram or a picture that illustrates why your monthly payment costs what it costs. Now, these are not necessarily drawn to scale, but it is going to illustrate the overall point. Number one, the most impactful piece of your monthly payment is actually the sales price of the home. Now, as you can see here on this pie graph or this pie chart, sales price represents 50%. Or in other words, a larger piece of the pie to what impacts your monthly payment. These other slices are broken up into a couple of different areas. Number one is interest rates. Two is property or homeowners insurance. Then you have your property taxes, and you have an other category. Now, other category refers to things like an HOA if it's applicable to the property. It also refers to things like materials, which is important for cost of repairs. So you may have seen the last several years, the cost of wood or lumber has gone up, the cost of siding has gone up, the cost for roof shingles has gone up, et cetera, et cetera. So the cost to maintain or repair a property is also more expensive. And then you have things like utility costs. So those have also gone up over the years. Now, since the pre-COVID market, what you've seen a lot of times is rising prices resulting in rising monthly payments. Most people associate the higher interest rates today for why things are more expensive. While some of that rings true, most of the reason why your payment has gone up or why a home purchase results in a much higher payment than anticipated is because all of these factors have gone up. Property taxes are at an all-time high. Insurance is higher. The other categories, HOA fees and costs for cures, like we talked about, costs for repairs, all of that is up. So if all of these things go up, obviously your monthly payment's going to go up. Now, here's a key factor. If you're looking to win in any market, you want to buy when you can control a monthly payment that you are comfortable with. You don't want to focus on one of these categories or slices over another one, with an exception of maybe sales price. If you try to time the market, it is almost impossible to do so. A lot of these factors you have no control over. There are a couple things we can bet on, though. Sales price will go up year over year or over time. Going back to the 1900s, there's only been a handful of times where prices have fallen. And every single time they have, something catastrophic or something abnormal has been associated with it. Think Great Depression, 1980s interest rate crisis, where interest rates were 19%. 2008, where the housing bubble burst, and that was because of over leveraged and mortgage crisis, not because homes were overvalued. So you are not necessarily going to see a sales price dip in the anytime interim future. You're going to see prices continue to go up. Now, more importantly, if interest rates were to come down, you're going to see a sales price increase. Think back to your Econ 101 days with a basic supply and demand. If demand outweighs supply, prices go up. Demand is going to increase as interest rates come down because interest rates describe the cost of borrowing money. If interest rates are lower, your demand is going to be higher because more people are interested in borrowing money because they can get it at a more affordable rate. And they will use that opportunity to buy more, which is going to push sales prices up. Overall, if you were thinking about making a move, you have a couple of things to look at. It is almost always across the board more affordable to buy at today's interest rate because that results in today's prices versus next year's interest rate and next year's prices. Even a significant drop in interest rates is typically not going to save you enough money to offset the growth in price, which, by the way, historic average in real estate is about 4.5% to 5% a year. So if you're looking at a $400,000 house this year, you're looking at a $420,000 house next year. That interest rate drop is not going to save you the difference. If anything, it'll cancel it out. Now, what you can do is if you buy that $400,000 house today at today's interest, when the interest rates do improve, you have that magic word or magic opportunity called refinance, where you can keep that price that you bought it at, redo your loan or refinance your loan at the new interest rate. And oh, by the way, if your house is worth more, that is now what we call equity in your pocket. Now, one other thing to keep in mind that I like to mention here when we talk about interest rates is what we call a blended rate. This is especially applicable to those of you that bought houses previously, maybe when rates were really good, or you've just established a good amount of equity in your house. A blended rate refers to your interest rates coupled across all of your debts. So you're looking at credit card debt, car payment, or car interest rates on those debts or loans, et cetera, personal loans, and so on and so forth, with a weighted average to your biggest asset, which is a house. Now, most of these other assets depreciate in value. Matter of fact, credit card debt isn't valuable at all. A car depreciates the second you drive it off the lot, whereas a home, in this case, in an asset, appreciates in value. So it is okay to have an interest rate on an asset that's appreciating in value. We don't want to have an interest rate, especially a high one, on an asset that depreciates in value or on something like a liability like credit card debt, which isn't an asset at all. A blended rate is calculating all these rates together. What we're seeing people do with that have equity in their property is they're selling their current house and using some of that equity as a down payment on their new home and some of that equity to pay off these things with higher interest rates. The credit card that has 26%, the car loan that has 14% or 9% or 12%, those are getting paid off. So your out of pocket monthly is actually the same, if not better, even with the higher interest rate on your new home. I hope this helps. It illustrates a little bit more of what goes into your monthly payment. And if you have questions, as always, reach out. I'd love to chat soon. Take care.